Thank you, and good afternoon, everybody. As Jack said, we have been conducting research in private credit for the last 11 years, and this is the highlight of a paper that we just released this morning. I urge you to go to our website and download the entire paper because there's much more detail available there that we've published. One of the first things that people asked about the private credit market is, what is it and how big is it? We attempt to do that or answer that in our paper. And we define private credit as that which is directly originated by the investor community, so primarily asset managers, but also pension funds and insurers, and therefore exclude the broadly syndicated loan market from that perspective. If I could get the slides back on, that would be great. How we come to the 3.5 trillion number, well, 2 trillion of assets are managed by those who responded to our survey this year. And then the rest we estimate from either having direct conversations with those who have not responded to our survey, who are our members, or we use various databases to cross-reference for the rest. And so we believe this is a fairly accurate number of the overall size of the private credit market as we define it. And that includes dry powder, so committed capital versus the actual deployed capital. And why some of our numbers differ from what you might see in other databases is that we include not just corporate lending, and some of those databases focus on corporate lending only, but also any other areas of lending where asset managers are active. So real estate, asset-backed financing, and infrastructure being the other 3 verticals that today make up 40% of the global AUM. So this is not an insignificant portion of the market that has for a very long time been synonymous with corporate lending. In terms of geography, the US is still very dominant. So it's about 65% by AUM. But Europe has grown very rapidly and is catching up. And whilst Asia is still tiny in the overall scheme of things, it's catching up even further. So the dynamic is that the history weighs heavily on the current stock. But when you look at the deployment numbers, and we don't have them broken down in this presentation, but you can see that in the report, Europe and other parts of the world are actually deploying more and faster than what you see in the US. And this is the global deployment number. What you see is a big jump in deployment and in 2024, which was primarily driven by a wave of refinancings. We had a big year in 2021. 2021 was the bumper year, both in terms of funding, but also in terms of asset raising. And a lot of these loans were financed at a time where spreads were high. The rates were not high yet. The rates went up in 22-23, which resulted in a lot of pressure on those borrowers. But the non-call periods for these loans have not expired. They started to expire in 23-24, and this is what led in a reduced spread environment now, and where rates have started to come down, to a huge demand for refinancing by the industry, and that's why you see this jump. So this is gross deployment volume, not the net new money that got into the economy. That's much smaller, and that's estimated to have grown maybe by a third or so. The investor composition of private credit has been subject of a lot of discussion, and again, we're lucky to have a 10-year window or 11-year window on how that's evolved. And there's a few things who are stable, which is a large component of investors are pension funds and insurers. Among the larger managers, insurance is even a larger component of the capital that they deploy. But if you look at the wealth and direct retail channel, that's the channel that's really grown the most, relatively speaking, more than doubling over the decade, and now making up roughly a quarter of the overall investor base, which brings with it a whole host of issues around investor protection, but also, crucially, product design, because retail and sort of wealth investors tend to be demanding of liquidity. And what's been driving the interest on the investor side? Well, performance is the simple answer. And in the middle, you can see that private credit has had a fairly consistent performance, a median IRR at around 9%, but with very low dispersion. So while you face potential upside, a bigger upside in some of the equity strategies, you also face a downside that is not the same in private credit. What's also been interesting in terms of comparing the private markets and looking at private credit versus other verticals is the level of return of capital to investors. What you see in the light blue line is the proportion of capital return to investors over time in the private equity space, and up in the dark blue is the private credit space. So the private credit has been more consistent in deploying capital for obvious reasons. Loans mature. It's not taking place in the same manner in private equity, which has a lot of implication, obviously, for investors, but also, again, for regulators. People worry about private credit and financial stability, as Jack said. And so one of the numbers we track is fund level leverage. This year, this is aggregate data. We've gone much more granular, and again, you can see that in the report. But broadly speaking, private credit funds are not levered more than 1-to-1, and roughly a third of private credit funds do not use any leverage at all. So we don't, and that's again been a consistent, steady picture across the time that we've been tracking the market. What about liquidity mismatches? Again, this is the sort of a distribution of population of funds that offer some level of liquidity to investors. Numbers could be confusing, but the punchline is most funds are locked up. They cannot, investors cannot demand capital. They cannot run on funds. They cannot destabilize the funds by demanding their money back. They have to wait till the fund matures. And of course, we talked about cockroaches and shenanigans in the private credit world. Well, what are the non-accruals? So what does non-performing loan universe looks like? And at the moment, it runs at around 2%, close to 2%, which for the type of credit, and most of it is still sub-investment grade. We have a growth in the investment grade universe driven by some of our members, but it's still very much in line with what you would expect for similarly rated credit elsewhere. And so not much to worry about, again, unless things change dramatically. What is also seen in the data is that stress in the portfolios that has come from higher rates has stabilized and now is actually improving again as rates and spreads are both decreasing. And here is a simple scenario modeling of what a shock could look like in private credit. And again, the punchline here is you would have to have triple the non-performing rates that we see in the data today and a dramatic fall in recovery rates for you to even start losing money. That's the sort of the 0% orange space. So again, we don't see that coming anytime soon, or the data is not showing us that that's going to be expected. So to conclude, we believe the growth is driven by structural factors, not cyclical ones, and is healthy, significant, but also sustainable. All of the financial stability metrics seem to be pointing that way. Returns might suffer unless we see sort of broadening of spreads again in the coming years, and then return of the M&A market, which is financed by private credit. And we don't expect any kind of endogenous shocks coming from the private credit space that could sort of endanger the financial system. Hopefully the rest of the conversation will shed even more light on all of the points that I mentioned. And again, I urge you to go to our website and download the report. Thank you for your attention.